So welcome back to another episode of the valuation calculator for another 3 companies. So this time we're going to be analyzing AVGO, Broadcom, Qualcomm, which is QCOM, and Micron Technology, so MU. So just to give you a quick recap, this is the valuation calculator that I developed within Investing Accelerator, and we use it as a quick way to see if a specific stock is undervalued or overvalued. So if there's a stock that you want me to look at, then you can click subscribe, leave a comment below, and next time when I'm making another video, I'll look at, what is it that the community want me to quickly analyze. So it's quite a handy tool. It allows you to see whether a stock is over or undervalued within a couple of seconds. So right now I have AVGO, which is Broadcom. And here you can see that I already pulled in the data, price to earnings, price to sales, cash flow, and book value. And we'll start with price to earnings. So here you can see the ratio for AVGO is 23.6 at the moment, and the industry average is 26. So this represents that AVGO is undervalued compared to the industry by 12%. So this means there's a 12% upside for AVGO. And the current price is $477, so the projected price is $537. When we're looking at valuation ratios, we look more than just earnings, which is the first one. We also want to compare that to sales, cash flow, and book value as well. So the next one is sales. And you can see the AVGO price to sales is around 6.43, and the industry average is 7.26. So this also represents a 13% potential upside. So a fair value would be at $539. So you can see the first two are actually quite similar in terms of what they're telling us. So that is a good sign. Now the next one is price to cash flow, which AVGO is 27, and the industry average is 40. And this represents a 48% upside, and the projected price is 708. Now this one is a little bit more aggressive. So when you're looking at these larger potential increases, it'll probably take a lot more time to get there. So if you're investing, let's say for the next 1 to 2 years, then you're probably aiming for this first target in terms of planning your exit. You would aim for the price to cash flow one, which is 48% increase over a longer period of time. Because what valuation ratios doesn't tell you is how long it takes to get there. Now the next one is price to book value, and this one you can see it's a negative 2%. In terms of valuation, so AVGO price to book is 9.25, and the industry average is 9.03. So usually when it is so close to the industry average, then I would just consider it to be fairly valued. So I wouldn't worry too much about this negative 2% decline, which means the projected price is 466, which is very close to the current price anyways. So that is basically the analysis for Broadcom. The next one is QCOM. Now, for Qualcomm, here you can see the price to earnings is 12, which compares to the industry average is 26. So this represents a potential upside of 109%, which the projected price is $258. And you can see the next one, price to sales, is also quite large in terms of the gap, 3.52 for QCOM, and the industry average is 7.26. And again, potential increase of 106%. Projected price 254. So for these two, because the increases are larger, I would consider it to be an outlier. Same for price to cash flow, 24 for Qualcomm, and the industry average is 40, so the projected price is 202. So these are going to be multi-year investments where it would take a little bit of time to get there, especially for the semiconductor market correction to be over. So then it shows you that out of the 4 indicators, 3 of them are showing you that significantly undervalued for Qualcomm. And for price to book value, is 13% overvalued in this case, which Qualcomm is 10.4 for price to book, and the industry average is 9. So then the projected price is 107. So it might actually get there in the short term because the market is quite volatile at the moment. But the long term for Qualcomm, I would still consider it to be undervalued. But these targets wouldn't be achieved in the short term. So short term meaning 1 year or less. So the last one we got here today is Micron Tech. So they actually recently just released earnings, and they have some really weak guidance. So within Investing Accelerator, we do look at more than just this valuation calculator. In fact, this valuation calculator is a very small part of our analysis. So here you can see the current price, and for Micron Technology, all of them are green, and you can see a lot of them are outlier. 3 out of 4 indicators are outliers. So price to earnings, it represents a 300% potential increase. Price to sales, 292%. And price to book, which is the last one, 640%. So the only reasonable projection for Micron Technology so far is this 24 price to cash flow ratio versus a 40 industry average price to cash flow ratio. So that gives you an idea that the projected price is 87. And if you do the technical analysis, like how I teach you in the free chart course, then you will understand that, hey, there is an opportunity within the semiconductor space. And for these kind of larger gaps, it's going to take probably multiple years to get there, but it shows that A, semiconductor is undervalued, B, many of these indicators are also undervalued, and when you're looking at other investors, they are going to be looking at these indicators as well, so it means that most of them are going to be in agreement. So it's just a matter of investing, patience, and if this is the first time you're watching one of the valuation calculator videos, then I'm going to include some basic training after this, so then you understand how this calculator works. Let me give you the background training for this valuation ratios calculator. So within Investing Accelerator, I developed a number of tools to basically shortcut and simplify investing by a mile. So it allows you to basically use a lot less time to analyze a stock and basically to only use 1 to 2 hours a week to invest in the market. And this is one of the many tools. Here you can see I'm analyzing Starbucks as an example. So within Investing Accelerator, we have a more in-depth training. So I'm giving you kind of like the shortcut condensed version here. When you're looking at valuations, you only look at PE ratio, which is price to earnings ratio, which is actually only one of the 4 most common ratios. Now, when I'm looking at ratios, I look at all 4 of them because sometimes they're not reliable. Sometimes you need to look at specific ones to interpret it correctly. So that's why you need to look at all the ratios together. So for example, for Starbucks, I only have 3 of the ratios available that I'm pulling from investing.com. So here you can see that the current price is this much, the Starbucks ratio is this much, and this is the industry average I pull from investing.com as well. So this gives you a feeling of what Starbucks stock price could be if they're at the industry ratio. And this also helps you calculate what is the potential price or the valuation of what Starbucks would be worth if it is at the industry level. Now, sometimes it is not comparable because the industry figure is not reliable, and sometimes it is really far off, which requires your judgment to determine which ratios are relevant and which ratios are not. So in this case, you can see that there are no outliers at the moment, and it represents quite a significant upside for Starbucks given the amount of money and sales they're making. So if we're just looking at sales alone, then you can see there's a 66% upside for Starbucks, which obviously shows that it is at a discounted stock. And you can see PE and PCF ratio. Then when you're looking at the industry average, this looks a little bit off to me, so I wouldn't rely on it as much. And when you're looking at these kind of large increases, it doesn't get realized immediately within 12 months. Usually it would take a little bit more time to realize that stock price. If you're using ratios, you want to focus on long-term investing because the stock price is not going to bounce back to the industry level within a year or so. Usually it takes a little bit more time. But the benefit of this valuation ratio calculator is that you get a projected price calculated from comparing to the industry average. And this is actually what a lot of mutual funds or hedge funds will do. And they figure out what is supposed to be the correct multiple for the industry or for that specific company so that they can calculate the potential upside and also help plan for your exit as well. So when you're looking at the valuation ratios calculator, it is only a very small part of the Investing Accelerator analysis. You need to combine that with technical analysis, fundamental analysis, valuation, which is what you see here, news, and other analysis as well. So then you can become 95% confident when you're investing in the market. So that's what this series is about. If you're interested in learning how to analyze stocks, and if this is your first time here, then I would suggest you to check out the free training down below in the first link in the description. And if you're interested in being part of Investing Accelerator, then you can schedule a call with me and we'll have a chat and discuss how you can become a better investor and potentially accessing some of these tools as well. So I'll also include a link to book a call in the description as well. So if that is interests you, then you can click on that and schedule a call with me. And yeah, that's basically how this valuation calculator works. And if there's any other stock that you're interested in me using this calculator for you and record another video, then you can leave a comment below, subscribe, and I'll see you in the next one.